In the 2010 Dodd-Frank Wall Street Reform and Consumer Protection Act, Congress required that for residential mortgages, creditors must make a reasonable and good faith determination based on verified and documented information that the consumer has a reasonable ability to repay the loan according to its terms. Congress also established a presumption of compliance for a certain category of mortgages called qualified mortgages. These provisions are similar but not identical to the board's 2008 rule and cover the entire mortgage market rather than simply higher price mortgages. The board proposed a rule to implement the new statutory requirements before authority passed to the Bureau to finalize the rule. The ability to repay or qualified mortgage rule requires you to make a reasonable, good faith determination that a member has the ability to repay a covered mortgage loan before or when you consummate the loan. You must consider, at a minimum, 8 specific underwriting standards when making an ability to repay determination. In addition, you must verify the information you rely on to make the ability to repay determination. Furthermore, you must also retain evidence you complied with the ability to repay qualified mortgage rule for a minimum of 3 years after consummation. A reasonable good faith ability to repay evaluation must include at least 8 ability to repay underwriting factors, which are 1. Current or reasonably expected income or assets, other than the value of property that secures the loan, that the consumer will rely on to repay the loan. 2. Current employment status, if you rely on employment income when assessing the consumer's ability to repay. 3. Monthly mortgage payment for this loan. You calculate this using the introductory or fully indexed rate, whichever is higher, and monthly fully amortizing payments that are substantially equal. 4. Monthly payment on any simultaneous loan secured by the same property. 5. Monthly payments for property taxes and insurance that you require the consumer to buy, and certain other costs related to property such as homeowners association fees or ground rent. 6. Debts, alimony, and child support obligations. 7. Monthly debt-to-income ratio or residual income that you calculated using the total of all the mortgage and non-mortgage obligations listed above as a ratio of the gross monthly income. And then finally, number 8, credit history.